The first stage, obviously, is the so-called melt up, and you're seeing a lot of people out there talking about a melt up now. I'm not saying I coined the phrase, but I think I was probably responsible for an awful lot of people picking up the term that was not used a lot prior to this past year. And I call melt up something that is highly unusual. What I see on the street these days is an awful lot of investors and pundits using the term melt up and then saying, a 200-point rally. That is not a melt up. That's just a nice rally. I mean, we've had a nice rally here in the last couple of weeks, but it's not a melt up. I think the melt up kicks in after we go to new highs. My guess is, we run up here to maybe 4650 and back off and then make another run. But the whole reasoning behind it, it's the hardest part for investors to grasp. They could buy into a bust up until recently because they could see that the Fed was tightening and that the economy was in trouble. There were a lot of signs that we had, big issues out there, a lot of excesses. But they had trouble understanding how, they said, hey, we made our top in 2021. Why do you think what makes you so sure we're going to go to higher highs? And not only higher highs, but substantially higher highs. And it comes down to, as you said, I'm a contrarian. Sentiment plays a big role in my work. And you had last year, in my 50 years, I don't think I've seen very many times where we've had such a consensus of investors on one side, meaning in this case, the bearish side. And so it's pretty easy to see that at some point, we were going to get a very big move in the other direction. And I think we're just beginning that now. There's still an awful lot of, I'd say the vast majority of investors still viewing this as a bear market rally. So yes, they're expanding their upside, but they still believe it ends badly and ends in something, before we get to new highs, ends in something that goes to new lows. I think before this is over, you will see almost all of that bearishness in capitulation and having to reposition bullishly. As you know, institutional investors can stay on the sidelines for just so long, and then all of a sudden performance pressures come in and they can't stay. I mean, obviously shorts have that issue, but any even long only portfolios can't just sit out a market that's starting to move higher. And I think we're at that breaking point now. You're seeing more and more firms raising their equity allocations. Again, it's very early. They're just starting. And sell-side strategists are raising their allocation to equities, all just starting. And I think what's ahead in the summer months and maybe into the early fall is that movement from defensive to more offensive investing.
All right, so it sounds like you're saying that basically FOMO is going to kick in here, fear of missing out. And if you're a hedge fund and the S&P is up 15% year to date, you've got your clients saying, hey, what the heck? Why am I missing out on all this action, and all the money that's on the sidelines is going to come flooding in? And you say once we hit 46.50, that's the trigger that all of this money on the sidelines really comes flooding in?
Actually, I think there's a setup. And again, it could either just push through that. I think the real money push comes after new highs, so above 4,800. But I do believe there's a setup where we might see it run to 46.50 and pull back as much as 10% before we go. Okay. I don't have high conviction on that, but I think that's a potential setup. So we may spend a few weeks on the downside before we go, because we're pretty overbought now, and we've certainly in the very short run had an awful lot of movement towards the bullish side. So from a trading perspective, I think, we've seen a shift. From a longer term investment perspective, I still say the vast majority are bearish.
Okay, so give me your upside targets for this current phase, for the melt-up, the parabolic melt-up phase, your upside targets for the S&P, for the Nasdaq, for the Dow, for the Russell. What are those?
Okay, my S&P target is 6,000 to 7,000. I think and people try to challenge and say, oh, maybe it'll even go higher than that. I said, that's, my visibility beyond that is impossible. Once you go into a parabolic, it can go wherever it would like in a very short time. But I think 6,000 to 7,000 captures the, pretty much the probability. And that's a wide range, but that's because we're going to be in a vertical parabolic blow off. Very, very euphoric blow off. On the Nasdaq, I am looking for 20,000. That looked pretty crazy not very long ago, but given the AI euphoria here, and I've taken a look at a lot of individual charts, and I can see an awful lot of stocks that not very long ago it was hard to see new highs. I can see major new highs in a lot of major tech stocks, et cetera. So, the semiconductor index is almost back to its all-time high. So, I mean, I think there's going to be a breakout to new highs in a lot of these stocks and also in the average. So,
NASDAQ any in particular there, just to interrupt you, any particular tech stocks that you see new highs in?
As a macro strategist, I got to stay away from individual names, but I can talk sectors. I think the semiconductors are going to lead the way. I had a target of 400 on this SMH before it split 2-for-1, so 200 on the post split. I've just raised that to 250, which would in the previous pre-split be 500. That's a big run. I mean, that's well beyond the old highs.
Yeah, for sure.
I think industrials will have a nice run. I think the commodities will, the XLB will go on to new highs. I think home builders, surprisingly, are going to show significant new highs. So there's a lot of groups and a lot of cyclical groups. As you know, we've had a narrative out there for a little while here that, this is a poor quality rally, that it's all based on AI and a few tech stocks.
Right.
Below the surface, if you look, that's not really a true statement. A lot of groups are not far off their highs, and it's not all AI. I mean, it's some, like the industrial index is really not very far away. Home builders have had a 50% run since the bottom. So there's a lot of groups that are both up and poised for a lot higher.
What does gold do during this rally phase, David?
Sure.
Gold, silver.
Just to finish out, because I kind of jumped around, my target on the Dow is 48,000. My melt up target on the Russell is 3,000. So I do think small caps are going to have a big catch up rally as well. In terms of gold and silver, I'm very bullish. I think they've obviously been disappointing and they've taken their time coming, but they have bottomed and they've had a secondary correction. And I think they're about to emerge from that secondary correction here. And ultimately, probably will top out after the equity indexes, but not that far after, and still be early in the bust or pre-bust. My targets are gold to 3,000 pre-bust and silver to 60 pre-bust. So again, big moves. And people have soured on them obviously quite a bit because of their laggard performance.
Right. Okay. So firstly, what timeline do you see this parabolic melt up happening over? What is the time frame pre-bust?
Yeah, I've been saying, and I'm guilty of this. I mean, if anybody wants to go on Twitter, they'll find plenty of critics because it is a melt up. It'll happen in a short period of time, and consolidations come and stretch everything out. So I thought it could have happened last year, and it got stretched out. I'm basically saying we'll probably see most of the melt up move by the end of the summer, which means could be Labor Day, but it could stretch into September. Could it stretch beyond that? Of course, but that's kind of my best guess right now. As I keep saying, consolidations that last for a month or two just stretch the scenario out for a month or two. So there's no magic to that. I'm not trying to time it precisely. It's the end of a 41-year secular bull market. I date the secular bull back to August of 1982. And I do that. A lot of people try to date it back to 2008-9. I use 1982 because that's really when the disinflation trend began and interest rates peaked out. So you've had this long run of PE multiples expanding inversely to the drop in interest rates. So, 10-year rates went from 15% down to almost zero. PE multiples went from single digits up to, market multiple to mid-20s. So that's to me all one secular bull market. We've had several cyclical bull markets within that. And I think this is the culmination of that 41-year bull market.
And that 41-year bull market starts to come to an end more or less by the end of the summer, by October of this year.
I think so.
Right.
And I think the highs of this bull market will not likely be seen again for decades. Not a decade, but decades.
The equity highs.
The equity highs.
You have different outlooks on commodities, which we'll get to.
Yeah, commodities very different. Precious metals very different.
Yeah.
Yeah, I'm so glad you asked, because the bust is another term like melt up that's being thrown around a lot these days. And frankly, if you ask people to define it after they use that term, I think a lot of them would not define it anywhere near what I mean by bust. I define a bust as something bigger than a recession, not the length of a depression. It's probably pretty much encapsulated in a 12 to 18 month time period like a recession is, but it will feel like a depression because you'll see a lot of major bank failures around the world. Less so in the U.S. because of what we went through in 2008-9. Our banks have some religion. They're less leveraged. Europe's in trouble. Canada's banks are more leveraged. So I think you're going to see more outside this country this time in terms of the banking crisis. But of course, we just saw the regional banks are fragile in different ways. So I do think that there's the potential for something quite a bit bigger than 2008-9 in terms of a financial crisis.
All right. So let's get into the specifics here. What are your targets during this bust phase? What do the markets do? How low do the markets go? And by markets, we'll go with S&P 500.
Sure. Yeah, I don't have a number because I don't know where the upside is, but I do have a percentage. And my view is it could be up to 80%. So we had a 90% bear market in 1929. I believe the Nasdaq fell close to that. I can't remember what the exact numbers were. It was over 70 in 2000, 1, 2, 3. It seems unrealistic or unbelievable to say 80% peak to trough, but that's the potential. Do I know it's going to be that big? No, but I think it's going to be, somewhere in that 60, 70, 80% range. And I actually think 80 is a legitimate number.
What does this look like in terms of economic growth? What would US GDP be doing during this phase?
Yeah, it's so hard to know because of some of these things with our economy and jobs and everything. I think there's potential still for, in spite of what looks like a tight job market, once this thing starts going south, I think you're going to see a lot of layoffs, and I think there's potential for double-digit unemployment. I think there's potential for double-digit negative GDP for a quarter or two. It's try to put that together with, a financial crisis. What I think is the big scenario that I think could happen is that you could have banking failures dominoing across the world all in a short period, similar to what we saw with Silicon Valley, except in a much larger fashion with much larger institutions. And so you're looking at central banks who will be deer in headlights, having not seen this before. I mean, they had a little bit of a learning experience in 2020, having to move pretty fast. And as I say, governments aren't designed to move quickly for that kind of event. Once banks start failing, they fail fast. The only thing that can respond to that is money. You will see, I think the Fed's balance sheet will grow to 30 trillion or larger, and similar proportionally around the world in the central banks. Again, these are unheard of numbers, but I think it's because we're going to be looking at something in proportionally that we've never seen before.